back down.
All right, guys, we're live. Spencer Israel, Stock Market TV. I've got the guys from the Gold Rush here with me, Jason Perez and Sam Gatlin. We just had a FOMC interest rate decision. It was, drum roll please, not a surprise to anybody. Federal Reserve just lowered federal funds rate by a quarter of a point, 25 basis points, as expected. We're going to start off with some live charting, kind of look at how the things are reacting right now, and then we'll go into, what this means going forward. So, guys, how's that sound?
Sounds great. Let's do it.
All right, we're looking at the IWM for some reason, which is
Yeah,
fine.
getting crushed, Spencer. You saw that initial pump right
Yeah.
at the top of the hour, and it's just been straight down ever since. Trading at new multi-hour lows here. We're looking at 1 minute candlesticks.
Wow.
We're getting pretty junky here with you guys today. It's not often I'm looking at 1 minute candlesticks, but when you have a big event like this, I think it warrants the short-term candlesticks. We could look at something like the Dow futures. Pretty muted action there. I was noticing the transports were moving pretty wildly, much like the Russell 2000 small caps. You saw that initial thrust higher at the top of the hour, and it's been straight down since then. Something like gold hanging in there, not much of a reaction so far. Crude oil,
I would have
little
thought you'd
bit
see some
down.
bigger candles on that gold chart.
Yeah, I know, right? It's been
That's
pretty muted, Spencer. Yeah. We usually
so.
see much bigger candlesticks than this. We can look at something like the dollar as well. The dollar is rallying, trading at the highs of the session. So
Okay. So
not really what the bulls want to see.
obviously, the fact that interest rates were just lowered by a quarter point is not a surprise to anyone who is paying attention, right, Jason? What was the Fed Funds futures market at? Like 99% chance of a cut today?
97,
Nin-
98 right
Okay,
before. Yeah, I mean it was almost there. So we knew what was going to happen. I mean, that's the thing, like it's the reason why like I don't need to pay attention to what the dot plot is or what the Fed speakers are saying. Like I know what's going to happen.
right.
And everybody else should know that too. It's when everybody pays attention to what they're saying and they read the news every day because in the news even when you read it even says like, "Oh, they think they're going to do this and this could possibly happen." It's like, no, if there's a 95%, if it's over 95%, it's most likely just going to happen.
Right. So obviously, the announcement itself is not even that's not even the news today. The news is gonna maybe, if there is anything, the news is gonna be what comes out of the press conference in about 25 minutes from now. We're not gonna live stream that or simulcast that or anything like that. Whoa. But but uh whatever comments come out of that could maybe cause some actual surprise action today. But let's look at the charts that we have prepared here that Sam and Jason put together for us. And I want to start with this, guys. We have now seemingly re-entered. There's what Jason was talking about. Look at that, 97% chance of a cut. We have now re-entered a rate cutting cycle. Rates had been lowered August of last year. Then they stopped in January, and we've been steady since then. Now we're down again. So, what does this broadly mean for markets? Start with you, Jason.
Yeah, for me, it's just we're going to continue on this path, and I think it's going to probably continue no matter what. I think, for me, it's why are we exactly cutting rates? If you were thinking like in the past, like let's say pre-2020, what would be the right environment for the Fed to start cutting rates? Well, you would say the market isn't making new all-time highs. Gold isn't at $4,000.
The economy,
the
Jason.
economy. Yeah,
Yeah,
well, sure. Yeah, they just don't. But they say that they care so much about that, but I really don't think they do. I really think they do care so much about inflation getting out of control. And there's a reason why we call it. I mean, go all the way back to the beginning of my career. It's the Greenspan put to the Bernanke put to the Yellen put to the Powell put. There's a reason why they say that's in the markets, and it's because when the market goes down, they usually come in and start coming in pretty heavy. I mean, we were buying BlackRock ETFs back in 2020, so they like to buy things pretty heavily at certain times. So I do think that the way this is and the way you want to look at this is if we're going to cut rates, it's probably just going to add to the rally. Yeah, you're going to see some short-term volatility. Every Fed day has a lot of volatility. I always tell people if you're going to trade a Fed day, the way to do it is wait 3 days. The first day, the reaction, it's just whatever. It's going to be all over the place. We're looking at the 1 minute candles, just like Sam was showing earlier. It's going up, it's going down, it's going sideways. Everybody's freaking out. And then tomorrow, you'll probably get the false move, which will go the opposite direction that the market will probably go in. Friday, you start to see what direction we might be going in. Really, Monday is when that's all really settled and people will get an idea of what it is. But for me, it's as we're cutting rates, I just continue to see that the cyclical story will probably continue to happen, meaning things like commodities like gold, copper miners. Copper miners are at a new all-time high right now today. I don't know if they're still there at the moment as we're speaking. So we're seeing that happening. We're seeing, oh, great chart, Sam. We're seeing the gold miners. Yeah, they had a pullback, but they're still really strong. So I really don't want to bet against that either.
These are multi-decade base breakouts, Jason.
Yes.
Let them dance.
Let them dance. I think these things are going to continue. XME at new all-time highs, just hitting off of that 2008 support actually and bouncing back up higher. So we're seeing all these sectors in the mining space continue to move higher. I think it looks like a bull market. I think the S&P 500 will probably just go higher. I think everything's probably going to go higher. We're in kind of a Goldilocks phase in the market at the moment. And what that means is everything's kind of rallying at a crazy, alarming rate at the moment. And they're cutting rates into that. I don't think that's going to stop anytime soon. But you're right. They're talking about the economy. The big thing that they were talking about today was the fact that we had, the slowing job numbers and the slowing growth in the United States and all these reasons why they had to cut rates. But really, let's be honest, Powell was really, really steadfast in the thinking, hey, we're not going to raise rates. We're not going to lower rates. If we lower rates, inflation will come back. And then all of a sudden they started a lot of political pressure. They started getting rid of people at the Fed and so on. They started making a lot of threats. And now they're going, hey, we got to cut rates. We just have to do it right now. I think Powell was completely right. I think, you might not see it in the very short term because each rate cut takes a little while to come into the markets and into the world. But I think in the long term, we're going to see a lot of inflation come into play because of these cuts. And I think Powell was absolutely right to be hesitant. So I think over time, I'd say the inflation story is probably intact. I would say the market's probably going to continue to go higher. And I'd say this is probably a mistake, but we're going to make money off of it. So what do I care?
True. And I think this chart number 2 that I brought along today, the iShares 1 to 3 year T-bond ETF, SHY, I think this is the number one chart to watch if you are a stock market bull. If you're long all the ARK stocks and the speculative tech and the flying cars and all of that, you want to see these yields at the short end of the curve come down, and you want to see this ETF decisively reclaim that VWAP from the 2020 high and enter a brand new primary uptrend. But Jason, we have this great setup in the SHY, but something like TLT is nowhere near completing this trend reversal. So what do you think that's telling us? What should investors take away from that? You have the short end of the curve kind of falling off a cliff, but the long end is still hanging in there in the middle of a range.
Yeah, I mean, it's the same thing I've talked about before, which is I'm so long the short end of the curve. So the things like SHY, I'm in futures, so we're looking at the basically 3 month to 2 year bonds. I'm long the short end of the curve, and I'm short the long end of the curve, meaning I'm short things like TLT and so on. And at the moment, it's a great trade because we're seeing that massive divergence. And most of the time when you see that type of divergence, that's really telling us there's liquidity coming into the market. And you're seeing that show up in things like the dollar this year getting hit pretty hard. You're also seeing that liquidity go into all these different areas. Gold miners are up, over 100% this year. We've got XME, metals and mining making a big move, lithium miners making a move. The S&P 500, speculative tech looks great. Global stocks look amazing. So we're seeing that liquidity show up in all these different areas. So I like the idea of continuing to watch this one and make sure to watch that spread between both of them. As long as we keep seeing shy outperforming and the spread of this yield curve moving the way it is, which is called a bull steepener, we're probably going to see most of these moves continue. I'd be surprised.
Can you explain that terminology? I don't think all of the audience
I was
is
going to ask
familiar
that
with
same
the
question.
bulls
Sam.
and the bear steepeners. You know, it can get pretty fancy with the bond market lingo.
Oh man, bond markets are full of big jargon words that sound very intelligent, but really they're easy to understand. So when we're looking at this chart, what a bull steepener is, and this is very easy to understand with this chart up, which is it's where these green arrows are. So that basically means that the 2-year yield is outperforming the 10-year yield. And so when we see that type of environment, usually it means that there's liquidity coming in the market. So if let's say the Fed is lowering rates, which they are right now, and let's say the 30-year rate isn't coming down as quickly as the Fed is lowering rates, that usually leads to more liquidity in the market, which is actually the reason why they lower rates in the first place. And the reason why this works out that way is that banks lend from the long end of the curve, but they borrow from the short end of the curve. So if a bank borrows money, like none of us have ever gotten zero interest rates when that was happening a couple, 4 years ago. I wish I could have went somewhere and got zero interest rates, but that doesn't happen. But if you're a bank, that can happen. So you can get these very low short-term interest rates on these on the debt. And so then you can borrow from that end. And let's say you borrow, a bank borrowing $1 billion. And let's say you loan $1 billion. So then you loan $1 billion. And at the time when rates were at zero, rates for the 30-year would be 2-3%. And so they're loaning at interest and making that money in the middle. And it's the same thing here. So when you see this steepening, what this is telling you is that there's more liquidity coming into the system. As the banks are able to lend more money, they're more incentivized to lend money because they don't have to pay it back at a bigger rate than they're able to lend it out for.
So in other words, bullish for the economy and markets.
In other words, green arrows bullish for economy.
Green arrows pointing up is good. Got it. There was a comment in the chat from Wavy about the balance sheet. I did want to bring up Sam, if you could slide 2, the new slide 2 for a second, if you can. This is a thing that I like to consult. Great thing that the journal does every time that there's a new Fed meeting announcement is they just highlight the changes in the statement. And the big one in the third paragraph there, the one that jumps out to me, is they changed the sentence from last time around, last month in September, we are going to continue to reduce our holdings of treasury securities to we're going to actually stop the reduction on December 1st. So they're done. It sounds like they're done selling for now.
I was wondering if that was going to come out today. So I guess they're done with quantitative tightening, which is very significant. That should make the market really rally once that news is digested. And I'm sure
is that more important than the quarter basis point cut?
Probably, it's got to be, right?
In a way, yes. But at the same time, one, they've been doing that for a while, so that's interesting that they stopped it. 2 is, yes, that is very important because now we're talking about not only are they it's very similar to like the environment that we see when we get these crazy rallies, which is or we're trying to stop the market from going down, which is, hey, we're going to stop the balance sheet runoff, and on top of it, we're going to cut rates. This is just adding to the liquidity. So this is going to actually boost most of the trades we're talking about today. Whether you're in speculative tech, whether you're in gold miners, like you're probably going to make some more money going forwards.
Well, let me just consult.
Good one, Spencer.
Let me just consult my speculative tech for a moment here, and not much of a reaction so far.
What's the ARC doing, Spencer?
What's what?
ARC.
I just looked. It's up 0.5% today. Yeah.
Once again, it's the event. It doesn't mean that this is a nothing burger. It's when does this stuff come into the market? And that's a question like nobody ever really asked, which is it takes a while for you're going to cut rates by 25 basis points. It's not going to really show up in the market for a little while. Even the last rate cut probably just is showing up in the market now. which is why we've seen this rally pretty recently. So I think it's just waiting for that to really come into the system and people to really digest it, and you'll probably see a huge move. And also, it really depends on, and this is what I've said a million times lately, which is it really depends on what Powell's going to do. Is he going to get on TV and is he going to talk real dovish? Is he going to get on TV and is he going to talk real hawkish? Because every time he's cut rates or done something like that, he's been very hawkish. So I think it's going to be interesting because he's going to talk a certain way, but the market will probably read into it another way. And I think we'll probably just head higher either way. This is very bullish information, extremely bullish information.
So what do you think this means for the currency markets, Jason? Because, we've seen the US dollar stop falling after it got absolutely crushed in the first half of 2025. So do you think it's going to come back and retest this key COVID VWAP in the US dollar index futures? Because that's kind of where my head is at. You have the commercials are now net long US dollars. That happened back here in 2021 when the dollar index was bottoming before this face ripping rally. So, do you think a bounce in the dollar is going to come?
I'd be very surprised to see this thing have a sustainable rally. Bounce, I agree with you. I think a bounce can happen. You have to have that positioning unwind a little bit. But I think the structure of it, like looking at the yield curve, looking at the what the Fed's doing, looking globally, because really what's happening right now is people are looking at the US and going, okay, we've cut, 50 basis points. But if you look all over the globe, we're cutting just as heavily as we did during COVID. We're cutting just as heavily, I'm talking globally, as we did in 2008 as well. So,
And you have emerging market currencies breaking out above that 2020 peak. I think that's a really big deal that not many people are talking about.
yes, it's a currency war and it's a global race to the bottom. It's the reason why when you look at gold pricing all these different currencies, you're basically seeing this rally against all these different currencies because people are starting to run to gold. Why are central banks buying so much gold and so on? Well, there's a reason. It's because these currencies that everybody's racing to the bottom, everybody's devaluing, everybody's cutting rates. And so, as you're cutting rates, you're putting more liquidity in the market, means more dollars out there, meaning the dollar should get weaker, but they're priced against the other currencies. So if the euro is doing the same thing, we're going to just see this chop back and forth between the euro, the dollar, and so on. So I do think that this is probably going to continue with the dollar going a lot lower. I think some of these emerging market currencies are a lot more interesting than any of the developed market currencies at the moment because some of these countries aren't doing the same thing like, the big global countries, the global superpowers. Yes, they're all going to try to, cut and work together and so on. Some of these countries are going to do something different. So I think that's where the money is going to be made, understanding which currencies are going to do something different and following a chart like this, following this index, finding the names inside of it. You can make a lot of money there. Stay away from Turkey and some of those types of countries, but there's a lot of countries with decent currencies that I'm definitely interested in.
Stay away from the country that got rid of their central bank, right?
That's a good rule of thumb.
I'm happy
Jason,
with
we didn't bring along the chart, but you mentioned there that countries are dumping US dollars and buying gold, and you brought this chart along to Gold Rush members the other day about how central banks around the world now own more gold, or they're really close to owning more gold than dollars for the first time, ever.
Ever. Yep. I mean, it's been many years. This hasn't happened for a very long time, and now they're starting to dump dollars for gold. I mean, that's a pretty interesting development. Dollars that's the world reserve currency. Everybody has to have some, but now they're moving more towards gold. I mean, we know the BRICS nations talked about it years ago that they wanted to move towards gold. I know Africa talked about wanting to move towards gold. And now we're kind of seeing it show up. Nobody's talking about it anymore, but we're seeing it in the actual action from the markets. So I think it's going to be interesting to keep watching that. I think it's also putting in quicker bottoms in gold at the moment. So I think, we might have some consolidation here, but I think these bottoms and these pullbacks will probably continue to get bought up in things like gold and even silver just by proxy at the moment, just because we have so many of these central banks buying gold so heavily.
This is off topic, but I just noticed this. Sam, if you go back to slide 2 for a second, this just caught my eye on that statement tracker. The very first word, look at that. They changed the word recent to the word available. because they don't have all the available data.
That's funny, Spencer.
There's a little thing
Yeah.
called a government shutdown that is preventing the release of government data for the last 30 days or so. So they don't even have it all, which is kind of funny. I've never seen that before. So I thought that was amusing just now. That caught my eye. But
It's
but
interesting
yeah.
because we have so many data points that are going in that haven't made it. You know, we're looking at some inflation, some zones, food inflation, and so on is happening. But then also, if you look at rents and housing, like that's also falling. So I don't know where they're going to end up when the government comes back, but I think it's going to be interesting. But I think overall, I think they're going to stay the path. I think even if we saw a little bit of an uptick in inflation, a little bit of an uptick in jobs growth, I don't think they're going to care. I think they're going to continue this cutting cycle. I think it's going to continue to go. I think it's become way too political. And I was going to also say, yeah, good for Turkey getting rid of a central bank, but that's a whole other conversation we could have one day.
That's a different. That's a whole other kind of worms. I don't think we want to get into that right now. Real fast. I'm just looking at the CME's FedWatch tool. Current probabilities of a cut in December 90%. So in Jason land, that's 100%, basically, right?
Yeah. Well, we'll see when we get closer, right? That's the thing about it. When we get closer, once you're like a week out, a month out, even like then you start to really go, okay, this is what's happening. But at this point, it's possible, and I think that they're going to just keep this cycle going. I don't think anything stops this train at the moment. I think they're just gonna cut, and it's kind of got to be this Goldilocks environment, and the market's just going to go up until something breaks, and at some point, something will break. But at the moment, it's like, ride the trend, make some money. Like there's a lot of things to be doing. We've been doing a lot of those, making a lot of money at Gold Rush for our members at the moment. So we'll continue to do that.
All right, let's talk. Let's go through more of these charts. We didn't talk about commodities. Let's talk about commodities for a second. I know there's some comments in the chat about that. What does this mean for the fact that we find ourselves in this, I guess, super cycle, right? Obviously, you guys been all over this all year, this year, last year, the year before that. The metals, we saw what happened in oil the last few days. Things have been ripping. What does this mean for those markets?
Yeah, I think that this is just going. I mean, I don't know exactly how to put it besides if you threw a bunch of gasoline on something and you were just waiting for someone to light a match, I feel like the Fed's ready to light that match. Like this is basically, we've been looking at this inflationary cycle for a long time. And if you look at this chart, it really mirrors what happens in the yield curve. And once again, like we went over earlier, it's just green arrow means more liquidity. So as we're seeing more liquidity come into these markets, we're going to see bigger moves come out of these markets. The CRB index, which is mainly energy, has been consolidating for a very long time. We have the tightest band squeeze ever in history on it right now. If we actually start to break out of these levels, let's say oil just continues up a little bit higher. It doesn't even have to go that much. Let's say $10. That's going to be the most explosive move any of us have probably ever seen in the oil markets, the commodity markets, and so on. It's just moving into a different area. We've already seen this explosive move happen in gold. We're starting to see it really, I mean, it's already shown up in copper and copper miners, but it's starting to continue to go and get even crazier in copper miners at the moment. Lithium miners look great. Uranium stocks look amazing. Now we're looking at coal is starting to make a move. We're picking some coal stocks. Sam and I have been picking aluminum stocks. Like it's literally like endless. The thing I don't want to do here is really bet against the fact that energy is not going to join the party. I don't want to front run it. I want to wait. I want to be patient for these breakouts. However, I bet this thing's going to take off, and I think this thing's going to take off quickly. It's going to be a big move, and I think the Fed just continues to throw gasoline on it, and we're just waiting for the match, and that match is probably happening very soon.
Look at the soybean futures too, Jason. You were talking to me earlier about this week, getting all excited about the grains. The grains haven't been trending higher in so long. My family back in Kansas is actually harvesting the soybeans right now, so I'm really happy to see this breakout happening right now.
Good harvest or bad harvest in Kansas? Did they say?
Mediocre.
Mediocre.
But of course, the cattle have been great. You know, they're kind of rolling over now, but still near all-time highs. So that's been really keeping us afloat.
Yeah, so the cattle price, and that's the thing that always have to think about with these markets. Cattle prices really put a lot of pressure on these grain markets because everybody's been asking about the grains lately, which is really cool. I'm very surprised a bunch of people are asking about grains. Like I love talking about grains, but a bunch of people are asking about grains and wondering, why they're not moving. And the pressure from live cattle, I mean, just look at a live cattle chart. It hasn't turned around in a year, basically, what over a year, maybe 2 years. It's just been in a solid uptrend, which puts a lot of pressure on the grains. Whether it's soybeans, you make soybean meal out of it, which is feed for cattle, or corn. You have feed corn, which is for cattle as well. So that ends up putting a lot of pressure on those markets when that price is up, mainly because you're talking about higher prices, less supply, less cattle out there, meaning less demand for things like soybeans and corn. So as we're seeing that type of move happen, we want to see live cattle start to roll over, and we're just seeing that start now. And then we saw this idea of the possibility of China buying more soybeans from the U.S. farmers. All of these together are really good catalysts for the possibility of soybeans finally to start moving. And I think corn's going to start moving as well. So I'm really excited to see that happening. It's been a while. These are new 52-week highs for soybeans. So let's see where it ends up. I'm excited about this one as well. We're going to write about this on Friday for our members too.
Totally. Yeah.
There's a question in the chat about the best way to play commodities. I don't know if we want to get too specific. I want to maybe save the most specific answer for your members, but broadly speaking, let's just take it in terms of vehicles, right? Would you look to the futures? Would you look to commodity ETFs, or would you go to stocks?
Futures for me always, because you don't have to deal with the roll costs, and you're not dealing. What that means is when you look at some of the commodity ETFs, USO is a great one to understand this. USO, go back to 2020 and look through today. You'll see that, UNG is an even better one. So natural gas, UNG is the worst looking chart compared to natural gas you'll ever see, and the reason why is the roll cost inside of that. So basically, when let's say I own a November contract of natural gas, and you're UNG, and you have to, because you're ETF, you have to roll to the next contract. You're actually going to pay for that next contract, which ends up leaving that in a bad position where that price continues to go lower against you, even though maybe that December contract would have just gone higher if you were in the December contract. So I stay away from the ETFs for that reason. But if I'm looking at just something broad that's easy, like I always suggest this one, DBA. DBA is one of the best broad ETFs for exposure in the commodity space. Basically, because you can't really get people always ask about coffee. How do I get exposure to coffee? And I say, well, there is no ETF for coffee anymore. What about cocoa? Well, there is no ETF anymore. Sugar, there's cane, but there's not many ETFs for a lot of these things. The best managed fund to get exposure to softs, grains, and everything is DBA. All of those are in there. And they basically rotate in a very similar way to the market, where the strongest ones will lead the way. A couple of years ago, the biggest ticker inside of that or the ETF was cocoa, and then it was coffee. It just changes over time depending on what's winning. So DBA, that's my answer. Probably the
It's
easiest.
kind of like the S&P 500 of the commodities. You
Yes.
buy more of the winners and you kick out the losers.
Exactly.
I like that.
Yeah, it's my favorite one for broad exposure. I think it's a good way to play it. More specifically, we'll get into that with the members, but broadly, that's a great one.
The concept that Jason's referring to is known, I believe, as contango, and the question in the chat about futures rolling too. Yeah, futures roll. You can't own a continuous, at least to my knowledge, you can't own a continuous futures contract. But the ETFs, the commodity ETFs, they have to own the front month, right?
Yes.
And the front month is always going to be less expensive than the next month, right?
Yes.
So
most of the time.
Most of the time, not always. You're right. There's the opposite is called backwardation. So most of the time, the current month is costs less than the next month, and so they have to they're always paying more to roll over for the next month. When you own a futures contract, yeah, you have to roll too, but you don't have to own any. No one makes you own a given month. That's what makes it unique to you. if you're the fund, you have to own the current month, right?
Yes. So if I'm trading futures, most of the time I'm looking at, okay, what are the dynamic, like I'll always look at the charts first, and then I'll go, what are the dynamics in, like, let's say I want to own December, like right now I own March soybeans, or if I want to own something like that. Either way, that gives me time. If I'm in something like, let's say I just decided today I want to buy the UNG ETF. Well, at the end of months, they probably already happened, but at the end, let's say I bought 2 weeks ago. At the end of the month, they're going to roll, and then I'm going to get hit with that cost. And so my position is going to go even lower than the actual natural gas really did. So I could have just gone to January, February, March, and probably owned it and made a lot more money that way than trying to own an ETF that's going to just get killed basically through roll costs over and over again, called contango.
All right, so listen up. I know Jerome Powell is either about to or just took the mic, so we should hop off. But before we do, I want to mention that Sam and Jason have been putting out all kinds of incredible research, trade ideas, reports. A report went out like just the other day about gold and silver. And that's all for their members. If you are a member of the Gold Rush, you already got it. Great. If you're not a member, if you're watching us on YouTube, there's the link that is pinned to the top of the chat. It's also in the description. You can just go to allstarcharts.com /gold-rush. That's the URL, allstarcharts.com/gold-rush to join the Gold Rush and get these guys as actual ideas. The real answer to the question, what is the best way to play commodities, is not just futures, right? It's more specific than that. Jason has the answer, and so do his people. So
we put out Sam and I are putting out the answers every single week. We've got tons of great trades that have been going out. I mean, God, Sam, I mean, we've literally made a killing over the last year. So basically, year to date, we have an insane return, bunch of great trades for everybody. So please join us. We'd love to have you.
And then you guys are going live tomorrow, as you do every Thursday. New reports every week, metals reports, bond reports, currency reports. It's all there. Use the link in the chat or description, or as I said, allstarcharts.com/gold-rush. Okay, I don't know what Jerome Powell was saying, but it must not be saying much, because I'm looking at a 1 minute chart and it's not really doing a whole lot.
The market went up and then it went down.
Oh, now here we go. Now we're talking. Seriously. I don't know what he just said.
The market went down.
Oh boy. Yeah. Yep.
Spencer, I'm going to bet you $20 the market is going to go up again, and then it's going to go down again.
Well, it might just go sideways. So
that's my point.
Yeah. Yeah. Well, whatever you just said. Seriously, whatever you just said, just undid all that. On the 1 minute chart, everything looks crazy. Just zoom out.
Most of the time.
Yeah, don't forget to zoom out. That's important.
Yeah.
This is just one day. One day does not make a trend.
Big reversal, though, in everything. My whole screen was green 30 seconds ago, and now it's all red, except for oil and a couple of sectors.
And gold.
Gold's unch. Gold is unched for me. There.
Silver is up 1.3. Copper's up 0.8.
Everything is down except for the VIX, and now it's just craziness. Now we're going all sorts.
Oh, look, it's going up again.
Yeah.
You owe me $20.
All right, let's get out of here. Thank you for watching, guys. Drop us a like if you're on YouTube. We appreciate it. Sam and Jason, good stuff as always, and try to avoid the whiplash from going back and forth on this thing.
All right, guys, take it easy.
Adios.
Thanks for being here, everybody.